What if I told you that everything you fear about the stock market, every crash, every correction, every headline screaming panic, could actually become your greatest advantage? Sounds crazy, right? But that's exactly what millions of people never learn, that the path to financial freedom isn't about predicting the future, it's about becoming unshakable no matter what the future brings. Imagine waking up tomorrow and seeing the market plunge 20%, and instead of panicking, you smile. Not because you're reckless, not because you're lucky, but because you understand the game in a way most people never do. For decades, the financial industry has sold us fear, confusion, and half-truths, all while quietly collecting billions in hidden fees. Meanwhile, everyday investors keep making the same emotional mistakes, buying high, selling low, chasing trends, and trusting the wrong people. But what if you could cut through all the noise? What if you had a simple, proven playbook used by the world's top investors? The very rules they follow when markets are calm and when they're in chaos? In Unshakeable, Tony Robbins and Peter Mallouk reveal exactly that. A straightforward roadmap to build confidence, eliminate fear, and grow your wealth even in the most volatile times. No Wall Street jargon, no empty motivation, just timeless principles that work, whether you're 20, 40, or 60. So today, we're breaking down the key ideas of the book, the hidden traps, the core four, the psychology that holds investors back, and the mindset shift that can change your financial life forever. If you're ready to stop worrying and start winning, then this is the summary for you. Chapter 1 sets the foundation for the entire book by addressing one hard truth. The financial markets will always be uncertain, and volatility is not a temporary condition. It is a permanent feature of investing. Tony Robbins opens the chapter by explaining that most people live in a state of financial anxiety because they misunderstand the nature of the market. They believe success comes from predicting what will happen next. In reality, long-term stability comes from understanding how markets behave over time and using that knowledge to build a strategy that keeps you calm instead of reactive. Robbins emphasizes that becoming unshakable is not about having more money. It's about having clarity and confidence. The goal is to reach a state where market corrections no longer trigger fear. Instead, you recognize that volatility is part of the process that makes wealth creation possible. Historically, corrections and bear markets have occurred regularly, yet the market has always recovered and gone on to reach new highs. The real risk is not volatility itself, but how investors respond to it. A major point of the chapter is that the financial industry often profits by keeping people confused. Complexity creates dependency, and dependency allows firms to charge high fees or sell products that do more for the advisor than the investor. Robbins argues that the path to financial freedom begins with education, because understanding how money works reduces fear. When fear drops, decision-making improves. That psychological shift is what he calls becoming unshakable. He also introduces the idea that true financial security is built on facts, not feelings. Investors often react emotionally to short-term news cycles, forgetting that the market's long-term trajectory has historically been upward. Robbins includes insights from some of the world's most successful investors, who all share a common mindset. They expect volatility, they plan for it, and they use it strategically. The chapter stresses that everyday investors can adopt the same mindset. No special access, no elite connections required. Another foundational concept from Chapter 1 is the difference between external and internal control. You cannot control interest rates, geopolitical events, recessions, or market downturns, but you can control your behavior, your asset allocation, your time horizon, and your costs. Becoming unshakable means building a system that protects you from your own emotions, a system that keeps your decisions aligned with long-term principles, even when the world feels chaotic. Robbins also clarifies that financial peace of mind doesn't require guessing the market bottom or top. Instead, it requires a diversified portfolio, low fees, and a disciplined approach. When these elements are in place, volatility becomes less threatening because the foundation is secure. The chapter encourages viewers to shift from a mindset of reaction to a mindset of preparation. Finally, Robbins concludes by positioning the rest of the book as a playbook, a structured guide that will show readers how to build this unshakable state step by step. Chapter 1 doesn't dive into technical strategies yet. Instead, it reframes the way people think about markets. The central message is that financial freedom starts not in the economy, but in the mind. Once you understand the true nature of volatility, and once you base your decisions on long-term principles, you gain something more valuable than money: peace of mind, regardless of what the market does next. Chapter 2 addresses one of the biggest sources of investor anxiety: the fear of market corrections and crashes. Tony Robbins begins by stating a fact that most people intellectually know, but emotionally ignore. Downturns are inevitable. They are not rare events. They are not anomalies. They are baked into the structure of the market itself. To help investors become unshakable, the chapter introduces 7 core facts that reframe how corrections and bear markets should be understood. Fact 1. Corrections happen often. Robbins highlights that, on average, the market experiences a correction every year. These drops typically range from 10% to 20%. Because corrections are normal, they shouldn't be treated as emergencies. The problem is that most investors interpret these movements as signals that something is fundamentally broken. The reality, the market's long-term upward trend has always included these temporary declines. Fact 2. Corrections are unpredictable. No expert, no economist, and no algorithm can consistently time when a correction will start or end. Robbins cites decades of historical data showing that markets often rise right after periods of bad news or fear. Missing even a few of the best-performing days drastically reduces long-term returns. So trying to guess market timing is statistically self-destructive. Fact 3. Most corrections are short-lived. On average, corrections last roughly 60 days. Investors often perceive them as long, painful stretches because the emotional impact is high, but the actual duration is relatively brief. This matters because selling during a correction usually means locking in losses just before the market rebounds. Fact 4. Bear markets also end, and bull markets last longer. Robbins explains that while bear markets do occur, historically they are followed by extended bull markets. This pattern has repeated through wars, political conflicts, recessions, and global crises. The takeaway: downturns are temporary, recoveries are persistent. Fact 5. The biggest market gains often follow the biggest declines. Many of the strongest single-day market surges happen near the worst days of a downturn. Investors who exit during a decline miss these recovery spikes. Robbins uses this fact to argue that staying invested is not just a preference. It is mathematically essential for capturing long-term growth. Fact 6. The market rewards patience. Over long horizons to 10, 20, 30 years, the volatility that scares investors becomes far less relevant. The longer you stay in the market, the higher the probability of achieving positive returns. Robbins reinforces a central principle: time in the market beats timing the market. Fact 7. Crashes are opportunities, not threats. This is the psychological breakthrough the chapter is pushing toward. Robbins shows that downturns allow investors to buy assets at significant discounts. Historically, those who continued investing during bear markets accumulate wealth at a faster rate once the recovery begins. The key is shifting perception. Volatility is not the enemy, emotion is. After presenting the 7 facts, Robbins stresses that the emotional cycle of investing often sabotages rational decision-making. Fear spikes during declines, causing investors to sell at the wrong time. Confidence rises during bull markets, tempting investors to buy late. Understanding the 7 facts helps neutralize these emotional impulses. The chapter concludes with an essential idea: certainty does not exist, but preparation does. By accepting volatility as a normal and necessary component of market growth, investors gain both psychological stability and strategic advantage. Robbins frames this mental shift as a core step toward becoming unshakable, confident, grounded, and guided by data rather than fear. Chapter 3 exposes one of the most damaging and least understood realities in personal finance. Most investors are paying far more in fees than they realize, and these fees quietly erode long-term returns. Tony Robbins argues that the financial industry is built on complexity. And complexity serves a purpose. It hides costs. Wall Street institutions often present themselves as partners in an investor's success, but many of their products and services are structured to benefit the firm at the investor's expense. Robbins begins the chapter by explaining the difference between visible fees and hidden fees. Most investors are aware of basic charges like expense ratios, but they are often unaware of trading costs, turnover-related taxes, one-to-one fees, sales loads, and revenue-sharing arrangements. These hidden layers, when combined, can significantly reduce the growth of a portfolio over decades. Robbins cites examples showing that even a 1% increase in annual fees can cost an investor hundreds of thousands of dollars over a lifetime due to compounding. A central theme of the chapter is the difference between fiduciary advisors and brokers. Fiduciaries are legally required to act in the client's best interest. Brokers, by contrast, must only meet a suitability standard, meaning they can recommend products that are more expensive or less efficient, as long as they are not entirely inappropriate. Robbins explains that most investors do not know which type of professional they are dealing with, and the industry often blurs this distinction intentionally. This confusion leads many individuals to accept advice from advisors who are financially incentivized to sell high-fee products. Robbins then turns to actively managed mutual funds, another area where investors frequently overpay. The chapter details how most actively managed funds fail to outperform their benchmark indexes over long periods. Even when some managers do deliver above-average results, the majority cannot maintain that performance consistently. Meanwhile, the fees charged by actively managed funds, often several times higher than index funds, continue to compound against the investor. Robbins explains that investors often chase past performance, unaware that a fund's track record is rarely predictive of future success. Another important concept is the illusion of skill. Robbins highlights research showing that many fund managers' performance is statistically indistinguishable from luck, yet the marketing around these funds often emphasizes the manager's expertise, strategy, or proprietary insights. This creates a perception of value that does not hold up under historical analysis. Robbins encourages investors to rely on data, not storytelling, when evaluating investment products. The chapter also touches on the conflict of interest inherent in revenue-sharing arrangements. In many financial firms, advisors are compensated more for recommending certain funds or products, even if those options are more expensive or less effective. Robbins argues that this structure incentivizes behavior that undermines the client's interests. Investors pay the price, often without even realizing the source of the underperformance. To help viewers recognize these traps, Robbins urges investors to ask direct questions. Is the advisor a fiduciary? How are they compensated? What fees are associated with the recommended products? Are low-cost index funds being presented as alternatives? Transparency, Robbins argues, is the investor's best defense. The chapter concludes with a powerful takeaway. Cutting unnecessary fees is one of the most reliable ways to increase investment returns. Unlike market performance, which cannot be controlled, fees are fully within an investor's control. By reducing costs, choosing fiduciary advisors, and focusing on low-fee index strategies, investors can retain more of their gains and significantly improve their long-term outcomes. Chapter 3 reinforces a core message of the book. Becoming unshakable requires understanding the financial system clearly, including the incentives, the hidden structures, and the fine print that many investors overlook. Chapter 4 focuses on one of the most important, yet least understood, components of Americans' financial lives, the 401k system. Tony Robbins explains that while 401ks are the primary retirement vehicle for millions of workers, they are also among the most opaque and fee-heavy financial products available. Most investors assume their employer-selected plan is designed with their best interest in mind. In reality, many plans contain layers of hidden costs, expensive mutual funds, and administrative structures that quietly undermine long-term returns. Robbins begins by pointing out that the shift from pensions to 401ks fundamentally transferred responsibility from corporations to individuals. Instead of receiving a guaranteed retirement income, workers must now manage investment choices, evaluate fees, and calculate risk, tasks most people are never taught to perform. The complexity of the system gives retirement providers significant leverage, often without employees realizing it. A critical theme of the chapter is fee awareness. Robbins highlights research showing that many 401k plans charge substantially more than necessary. These costs take the form of high expense ratios, plan administration fees, record-keeping charges, investment management fees, and revenue sharing agreements. Because fees compound negatively, even a small difference -1% or less can reduce a retirement account by hundreds of thousands of dollars over several decades. Robbins emphasizes that few participants are given transparent disclosures, and even when disclosures are provided, they are typically buried in technical language. Robbins also examines the conflicts of interest built into the retirement plan ecosystem. Many plan providers select funds not based on performance or cost efficiency, but based on revenue sharing arrangements that benefit the provider. As a result, employees often end up with a menu of high-cost, actively managed funds even when low-fee index funds are available in the broader market. The participant believes they have a curated set of recommended choices, when in fact the options may be driven by corporate incentives. The chapter also critiques the lack of fiduciary responsibility in many 401k plans. Unlike independent fiduciary advisors, plan providers are not always required to act solely in the participant's best interest. Employers, often unfamiliar with investment management, rely heavily on these providers to construct the plan, creating another layer of misalignment. Robbins argues that this structure makes retirement planning unnecessarily inefficient and expensive for ordinary workers. To illustrate the problem, Robbins discusses the example of broker-sold plans versus open architecture plans. Broker-sold plans tend to be packed with high-fee mutual funds and share classes that generate commissions. Open architecture plans, by contrast, allow employers to choose from the full marketplace of low-cost investment options. Robbins argues that most employees do not realize which type of plan they are enrolled in, leaving them vulnerable to unnecessary and avoidable fees. The chapter then shifts to solutions. Robbins outlines steps employees and employers can take to improve retirement outcomes. These include demanding full fee transparency, understanding exactly who is being paid and for what, identifying the total all-in cost, not just fund expense ratios but administrative and indirect fees, advocating for low-cost index funds, the most reliable long-term investment option for the majority of participants, encouraging employers to hire independent fiduciaries, professionals legally required to place participants' interests first. Robbins explains that reducing fees and ensuring fiduciary oversight can dramatically increase the amount participants accumulate for retirement without requiring higher contributions or riskier investment strategies. Chapter 4 concludes with a direct message. The 401k system is not broken, but it is often mismanaged and misunderstood. Investors who learn how the system works, ask the right questions, and push for low-cost, transparent structures can reclaim control of their retirement. Becoming unshakable means understanding not only the market, but the mechanisms governing long-term savings. Chapter 5 addresses one of the biggest challenges in personal finance: identifying trustworthy financial advice in an industry built on conflicting incentives. Tony Robbins makes a crucial distinction early in the chapter. The financial world is divided between professionals, who are legally required to put your interests first, and those who are not. Understanding this difference determines whether an investor builds wealth efficiently or unknowingly pays for products that benefit someone else. Robbins starts by clarifying the difference between fiduciaries and brokers, a theme introduced earlier but explored in greater depth here. Fiduciaries must place the client's interest above their own. Brokers operate under a much looser suitability standard, meaning they can recommend expensive or underperforming products, as long as they are not blatantly inappropriate. Robbins explains that most investors assume their advisor is a fiduciary, but in reality, the majority are brokers or dual-registered advisors with mixed obligations. This structural confusion is one of the industry's greatest weaknesses. One of the most impactful concepts in the chapter is the confusion business model. Robbins explains that financial companies deliberately use complex language and opaque product structures to create dependence. When investors feel unsure, they lean on advisors, and that dependency gives firms power to charge higher fees, push proprietary products, or steer clients into revenue-generating services. Robbins explores several common tricks of the trade used in the advisory world. 1. Proprietary products. Many firms encourage advisors to sell in-house mutual funds or separately managed accounts. These products often carry higher fees and lower transparency. Advisors may receive higher compensation for steering clients into these options, creating a direct conflict between the client's best interest and the advisor's incentives. 2. Commission-based compensation. Robbins explains how commission structures reward activity, not outcome. Selling annuities, share mutual funds, or insurance products often generates large, upfront commissions. The client experiences high costs, long surrender periods, or restricted liquidity, while the advisor earns immediate compensation regardless of long-term performance. 3. Revenue sharing and pay-to-play. Many large financial institutions receive payments from fund companies in exchange for placing their funds on recommended lists. Investors think these lists represent high-quality selections, but in reality, they often reflect commercial relationships rather than investment merit. For high-turnover strategies, some advisors trade frequently to generate transaction fees or justify their roll-through activity. Robbins highlights that excessive trading often reduces returns through costs and taxes, while providing no real benefit to the client. The chapter also examines retirement plan conflicts, where advisors may recommend expensive share classes or actively managed funds for 401(k) plans, even when low-cost index fund alternatives exist. Robbins stresses that these conflicts are rarely disclosed and often misunderstood by plan sponsors and employees. A significant portion of the chapter focuses on how to identify a trustworthy advisor. Robbins provides a framework for evaluating financial professionals through direct, specific questions such as, are you a fiduciary 100% of the time? How are you compensated? Do you receive commissions or third-party payments? Are there proprietary products you are encouraged to sell? What is your total all-in fee for managing my portfolio? Robbins emphasizes that transparency is the single greatest indicator of trustworthiness. Advisors who avoid clear answers or respond with jargon should be viewed with caution. Those who provide full disclosure, embrace low-cost strategies, and operate under a fiduciary standard align more closely with the investor's long-term interests. The chapter concludes with a central message: you cannot become unshakable if the foundation of your financial strategy is built on conflicted advice. Achieving financial confidence requires eliminating unnecessary costs, removing biased guidance, and partnering only with professionals whose interests are legally aligned with yours. Robbins urges investors to treat the search for a trustworthy advisor with the same seriousness as choosing a business partner, because the impact on long-term wealth is enormous. Chapter 6 introduces one of the most practical frameworks in Unshakeable, the Core 4, a set of principles designed to guide every investment decision with clarity, discipline, and long-term focus. Tony Robbins argues that while markets are unpredictable, investor behavior can be systematized. The Core 4 offers a structure that helps investors navigate volatility, avoid unnecessary risk, and capture long-term growth without relying on market predictions or emotional reactions. Core Principle 1. Don't lose money. The first principle focuses on risk minimization, not through avoiding markets, but through smart allocation and cost control. Robbins explains that the most effective way to protect capital is by reducing fees, minimizing taxes, and avoiding high-risk speculation. Many investors mistakenly think not losing money means avoiding downturns, but Robbins clarifies that losses often come from poor decisions, not market cycles. He emphasizes that protecting downside risk requires broad diversification across asset classes, avoiding leveraged or overly complex products, using low-fee index funds as core holdings. The principle echoes Warren Buffett's famous rule: the best way to compound wealth is to avoid unnecessary drawdowns that slow portfolio recovery. Core Principle 2, Asymmetric Risk, Reward. Robbins explains that world-class investors look for asymmetric opportunities, situations where the upside potential is significantly greater than the downside risk. Most retail investors do the opposite. They take large risks for small potential returns, often without realizing it. Asymmetric investing does not require hedge funds or private deals. It can be achieved through strategic asset allocation, dollar cost averaging, taking advantage of declining markets to buy at discounted prices, maintaining a long-term time horizon that allows compounding to do the heavy lifting. The key message: investors should structure portfolios so the rewards significantly outweigh the risks across market cycles. Core Principle 3, Tax Efficiency. Robbins highlights that taxes are one of the most overlooked drags on performance. Many investors unknowingly reduce their returns by holding high turnover funds or actively trading in taxable accounts. Robbins stresses that tax efficiency is not optional. It's a critical component of long-term success. Strategies include favoring index funds with low turnover, using tax-advantaged accounts for 101(k) IRA, Roth IRA strategically, avoiding unnecessary short-term gains, considering asset location, placing tax-inefficient assets in tax-deferred accounts. Robbins explains that improving tax efficiency often adds more to long-term wealth than trying to beat the market. Core Principle 4, Diversification. The final principle reinforces Robbins' belief that diversification is the only free lunch in investing. He breaks diversification into multiple layers, diversifying across asset classes: stocks, bonds, real estate, alternatives; diversifying geographically U.S. and international markets; diversifying within each asset class through broad market indexes; diversifying across time through consistent contributions. Robbins clarifies that diversification is not about avoiding losses. It is about reducing the magnitude and duration of losses. A diversified portfolio behaves more predictably, enabling investors to remain disciplined when markets become volatile. Bringing the core four together. The chapter ties these principles into a cohesive decision-making framework. The core four is designed to reduce emotion, eliminate guesswork, and anchor investors to strategies supported by decades of empirical data. Robbins stresses that the core four is accessible to everyone. No specialized knowledge, high income, or advanced investment tools needed. Robbins closes by reinforcing that the core four is not a rigid rule book. Rather, it's a mental model that aligns investor behavior with long-term success. When applied consistently, the core four helps investors stay calm during volatility, avoid destructive decisions, and grow wealth through disciplined, evidence-based strategies. Chapter 7 addresses one of the most misunderstood realities of investing. Bear markets are not obstacles to long-term success. They are integral to it. Tony Robbins explains that investors who understand the nature of bear markets gain a significant advantage over those who react emotionally. The chapter's goal is to remove fear by grounding expectations in historical data and providing a structured mindset for navigating downturns. Robbins begins by defining what a bear market really is. Typically a market decline of 20% or more from recent highs. While the word bear often triggers panic, Robbins emphasizes that bear markets are temporary, predictable, and necessary. Historically, they occur every 3 to 5 years, and they have always been followed by full recoveries and new market highs. The key insight he drives home is that corrections and bear markets are not signs of permanent failure. They are the reset mechanism that allows markets to grow over the long term. A major theme of the chapter is the psychology of downturns. Investors often trust the market during expansions, but lose confidence during declines. Robbins explains that emotional decision-making, particularly selling during fear, is the single most damaging behavior in investing. Data shows that average investors dramatically underperform the market because they repeatedly buy high and sell low. Becoming unshakable requires breaking this cycle. Robbins then lays out several historical facts to help investors reframe their view of market declines. 1. Bear markets have always been temporary. Every bear market in U.S. history has eventually been followed by a bull market. Some recoveries are quick, others take time. But the pattern is consistent: long-term upward movement despite short-term downturns. 2. Bull markets last longer than bear markets. Bear markets are typically measured in months. Bull markets are measured in years. Missing even a small portion of a bull run can severely reduce long-term returns. 3. Market bottoms are only obvious in hindsight. Robbins emphasizes that waiting for a perfect moment to re-enter the market is nearly impossible. Investors who remain invested or continue buying through downturns capture the eventual upswing. The chapter also highlights how wealthy investors approach downturns differently from retail investors. While the average person reacts with fear, sophisticated investors view bear markets as discount seasons. When asset prices drop 20 to 50%, long-term investors have an opportunity to buy shares at a substantial discount. Robbins explains that downturns are often the periods that produce the greatest forward returns because future growth compounds from a lower entry price. To help investors internalize this perspective, Robbins introduces the idea of systematic behavior during declines, including continuing regular contributions, dollar cost averaging, rebalancing portfolios to maintain target allocations, avoiding emotionally driven decisions, reviewing long-term goals rather than short-term news. He includes research showing that investors who maintain consistent buying behavior during bear markets often outperform those who attempt to time entries and exits. The chapter also explores the importance of asset allocation during downturns. Robbins stresses that a well-diversified portfolio can soften the psychological impact of bear markets because diversified holdings rarely decline uniformly. Bonds, cash equivalents, and defensive sectors can provide stability, giving investors the confidence to stay invested in equities without panicking. Robbins further warns against relying on media headlines during market turmoil. The financial news cycle thrives on fear-driven narratives, often exaggerating risks or presenting short-term events as existential threats. Investors who allow headlines to dictate decisions often exit the market at precisely the wrong time. Chapter 7 ends with a clear message: you cannot control bear markets, but you can control your response to them. The investors who become unshakable are the ones who anticipate downturns, understand their historical context, and use them as opportunities rather than threats. Bear markets are not roadblocks, they are accelerators for those who stay disciplined, maintain perspective, and continue executing long-term strategies. Chapter 8 shifts from external market forces to the internal psychological biases that undermine investment performance. Tony Robbins argues that becoming unshakable requires more than understanding market mechanics. It requires recognizing and controlling the behavioral patterns that lead investors to make costly mistakes. Decades of research in behavioral finance show that the greatest threat to long-term wealth is not market volatility, but investor behavior. Robbins identifies 6 major psychological mistakes and explains how each one damages financial outcomes. Mistake 1: seeking confirmation instead of information. Robbins explains that investors often look for evidence that supports their existing beliefs, rather than objective data. This leads to poor decision-making, particularly during market extremes. For example, bullish investors may ignore warning signs during overheated markets, while bearish investors may cling to negative forecasts even as conditions improve. Robbins emphasizes that disciplined investors must evaluate information independently and avoid letting emotional bias shape their interpretation of market events. Mistake 2: overconfidence. Overconfidence leads investors to believe they can outsmart the market, typically through timing, stock picking, or reacting to headlines. Robbins cites studies showing that even professional fund managers struggle to beat index benchmarks consistently. Retail investors fare even worse. Overconfidence often results in excessive trading, high transaction costs, and an inflated sense of control over unpredictable outcomes. Robbins highlights that humility, not confidence, is the trait shared by successful investors. Mistake 3: home bias and lack of diversification. Many investors concentrate their portfolios in local markets, familiar companies, or a small number of sectors. Robbins explains that this reduces diversification and increases risk exposure. U.S. investors often overweight domestic stocks, ignoring opportunities in international markets. Robbins reinforces that broad global diversification is essential for reducing volatility and improving long-term stability. Mistake 4. Loss aversion and emotional selling. Loss aversion is one of the strongest psychological forces in investing. The pain of losing money is psychologically more intense than the pleasure of gains. As a result, investors often sell during downturns to avoid discomfort. Even though downturns are temporary, Robbins stresses that emotional selling is the most destructive behavior. It locks in losses, breaks long-term compounding, and causes investors to miss market recoveries. He encourages investors to anchor decisions to data and long-term strategy, instead of short-term emotions. Mistake 5. Herd mentality. Robbins explains that many people follow the crowd because it feels safer. Herd mentality leads investors to chase hot stocks, buy during bubbles, and sell during crashes. Precisely the behaviors that sabotage returns. Bubbles form because investors reinforce each other's decisions, not because fundamentals justify rising prices. Robbins advises investors to apply disciplined rules, such as asset allocation targets and rebalancing, rather than following market sentiment. Mistake 6. Focusing on noise instead of signal. Robbins highlights that financial media thrives on sensationalism. Headlines emphasize volatility, crises, and predictions to capture attention, not to provide actionable guidance. Investors who pay too much attention to short-term news often become reactive, shifting strategies based on temporary events. Robbins encourages filtering out noise and focusing on long-term principles, costs, diversification, tax efficiency, steady contributions, and time in the market. Building an unshakable mindset. Robbins concludes by emphasizing that discipline and self-awareness are critical traits. For successful investors, the goal is not to eliminate emotion, but to design a system that prevents emotion from dictating decisions. Automated contributions, clearly defined asset allocations, and long-term time horizons help investors stay on track regardless of market conditions. The core message of Chapter 8 is direct. Your internal psychology is the final barrier to financial freedom. Learning to silence the emotional reactions that sabotage decision-making is what allows investors to become consistently rational and ultimately unshakable. Chapter 9 shifts the focus from market strategies and behavioral discipline to a broader, more foundational concept, the true meaning of wealth. Tony Robbins argues that financial freedom is only one component of a fulfilling life. Real wealth includes emotional well-being, purpose, relationships, health, and contribution. This chapter reframes the pursuit of money, emphasizing that financial success should support a meaningful and balanced life, rather than become the sole objective. Robbins begins by challenging the assumption that accumulating more money automatically leads to greater happiness. He explains that people often chase income, status, or possessions but still feel anxious or dissatisfied. The problem, he argues, is not the pursuit of financial growth, but the belief that money alone will resolve deeper emotional or psychological gaps. Robbins positions financial mastery as a tool essential, but insufficient, for long-term fulfillment. One of the core ideas in this chapter is the power of focus. Robbins emphasizes that life improves not through external circumstances alone, but through the decisions we consistently make about what to value, what to prioritize, and how to interpret challenges. He explains that two people can experience the same event, but feel entirely different outcomes because of their internal focus. Thus, becoming unshakable is both a financial and psychological transformation. Robbins highlights 3 categories of wealth. Emotional wealth. This includes resilience, gratitude, optimism, and the ability to handle stress. Robbins argues that emotional stability is the foundation on which financial success rests. Without emotional wealth, market volatility or life pressures can destabilize even the strongest portfolio. Relational wealth. Robbins stresses that meaningful relationships, family, friends, partners, community, contribute more to long-term well-being than any investment account. He notes that many financially successful individuals struggle with loneliness or strained relationships because they prioritized income over connection. Financial wealth. While financial security is essential, Robbins frames it as a support system that gives individuals freedom of choice. He reiterates that smart investing, low costs, diversification, and long-term discipline help build this foundation. But the ultimate goal is to use financial wealth to enhance life, not control it. A major theme in Chapter 9 is gratitude. Robbins explains that gratitude reduces stress, enhances decision-making, and counters negative emotions like fear and scarcity thinking. When investors operate from a mindset of gratitude rather than fear, they make more rational choices and maintain discipline during market volatility. The chapter also emphasizes contribution as a defining element of real wealth. Robbins states that giving, whether time, resources, or knowledge, creates a sense of fulfillment that financial accumulation alone cannot offer. Contribution shifts focus from personal gain to collective impact, which strengthens emotional and relational wealth. Robbins closes the chapter by reinforcing the central message. True wealth is a combination of financial stability and psychological well-being. Becoming unshakable is not only about surviving market cycles. It's about cultivating a mindset that produces confidence, clarity, and a meaningful life regardless of external conditions. The most important decision of your life, he argues, is choosing to live by values that create holistic wealth, not just financial success. Unshakeable distills Tony Robbins and Peter Mallouk's clearest, most actionable ideas on how everyday investors can build financial confidence. In a world full of uncertainty, the book's central argument is that market volatility is not a threat. It's an unavoidable and often advantageous part of long-term investing. Success doesn't come from predicting the future. It comes from having a simple, disciplined system that keeps emotions from undermining good decisions. Across the book, Robbins highlights that investors are bombarded with misinformation, high fees, and conflicted advice. He reveals how Wall Street structures products, retirement plans, and advisory services in ways that often benefit institutions more than individuals. By understanding hidden fees, advisor incentives, and the difference between fiduciaries and brokers, readers gain the clarity needed to protect themselves and keep more of their returns. A major theme is that investors don't need complexity. They need principles. The Core for framework provides those principles. Don't lose money. Protect your downside through diversification, low fees, and disciplined decision-making. Asymmetric upside. Look for strategies where the potential gain outweighs the risk. Tax efficiency. Reduce friction that quietly erodes returns. Extreme diversification. Spread risk across asset classes, regions, and time. Robbins dedicates several chapters to corrections and bear markets, showing that downturns are not events to fear, but opportunities to accelerate wealth building. Historically, every crash has been followed by a recovery, and many of the market's best days come immediately after its worst. Investors who stay invested or continue buying benefit most. The book then shifts inward. Robbins stresses that the greatest threat to long-term success is behavioral, not technical. Overconfidence, loss aversion, chasing trends, emotional selling, and reacting to headlines are the largest destroyers of wealth. Becoming unshakable means mastering your psychology, automating smart behavior, and committing to data-based decisions instead of emotional reactions. Finally, Robbins reframes the concept of wealth itself. Real wealth is not just financial freedom. It includes emotional stability, meaningful relationships, health, gratitude, and contribution. Money is a tool, not a destination. True success comes from using financial security to build a life that aligns with your values and supports the well-being of others. The book's conclusion reinforces the core message. You don't need to be a market expert, economist, or high-income earner to achieve financial freedom. You need a strategy, discipline, and the right mindset. When your emotions no longer dictate your financial decisions, you become unshakable, confident, resilient, and in control of your future. If this summary helped clarify how to build real financial freedom, make sure you hit the like button, subscribe, and turn on notifications so you never miss another breakdown of the world's most important money books And drop a comment below. Which principle from Unshakeable do you want to apply first? Your financial transformation starts with knowledge, and you're already on the right path. Let's keep building.